Hello, chart watchers, and welcome to this Thursday, January 31st, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we're getting a little bit of a melt up today, especially in the NASDAQ, but let's start off with the Dow Jones Industrial Average currently up 15 points. The S&P 500 up 27, or roughly 1%. The NASDAQ up about 1.5%, currently at 7297, almost 7,300, up 115 points. The Russell 2000 also participating, up about 14 points today, almost 1%. 10-year Treasury yield, this is the big, big variable, I don't know what we want to call it, but the 10-year Treasury yield down 6 basis points today, 2.63%, getting close to that early January low. This is a little unusual because we tend to see Treasury yields going in the same direction as equities, and right now they are going polar opposite. The volatility index currently down 4%, as you might expect, and it is down in the 16s. It is moving below the lows we saw earlier in January and threatening the 16 level that we saw back in 2018. We'll need to keep a close eye on that. Leading to the upside today, communication services. No big surprise here. This group up more than 4% today based on Facebook's earnings. We'll talk about that in a bit. Materials on the other end of the spectrum actually down more than 1%, but rallying nicely off of a 20-day test, which is always a bullish development in an uptrend. Moving on to that internet space, you can see internet stocks performing extremely well today, currently up more than 5%, and that is a result of the Facebook earnings. They had a very bullish forecast in addition to beating their estimates on Wall Street, and the stock you can see up very nicely today, up well over 10%. General Electric, we've talked badly about GE for quite a while, but you can see nice uptrend here, had a nice move, sideways consolidation, wanted to get through that $9 level. We did it easily today on very heavy volume as GE reported its earnings. To the downside, and the reason that we're seeing materials down, the report out on Dow DuPont was not good. You can see a huge drop here. Stock down almost 7.5% today. So mostly good things going on today in the market, Erin. Definitely the NASDAQ, which had been lagging a little bit, really starting to show some leadership here the last couple of days. But you still got stocks like Dow DuPont. Not everybody's participating here.
That's for sure. Yeah, I'm interested in watching where the market's going to go, especially the Dow, because Dow had been negative. Looks like it just hit positive territory. So be very interesting. If you have the NASDAQ up over 1.5% right now and the Dow was negative just moments ago. So it's kind of an interesting setup.
Yeah, I mean, on the Dow, of course, we did have a Dow DuPont. That's down 7.5%. So that's weighing on the Dow. We've also got Intel down 2.5%. Goldman Sachs is down. Of course, Microsoft and Visa both reported. They're both down. So this has definitely been much more of a technology NASDAQ kind of a rally that we have seen since the Fed came out yesterday at 2 o'clock. And, they're talking about exercising patience. I think that's what the market was looking for a couple of months ago when the market kind of panicked because of the Fed's insistence that they were going to raise rates in 2019 a few times. And now they've kind of backed off of that and said they're going to be patient, a little bit more data dependent. And I think the market likes that.
Yep, absolutely. Yeah, it was very clear yesterday after the minutes came out or after he spoke. So very interesting. See how this progresses.
Yeah, and I mean, we're now trading back above 20-week EMAs. We still have an Amazon report after the bell tonight, and then we've got the jobs report in the morning. We know how things can flip pretty quickly, but so far so good, I would say, if you're more on the bullish side of things.
Yes, the bulls are pretty happy. All right, upcoming schedule. Tomorrow, Mary Ellen is going to be here for What's Hot and What's Not. Tom, you got a workshop on Tuesday of next week. Dan Russo is going to join us on Wednesday of next week, and that should be a great show as well. Roman is going to join us as well, also one of the Mr. Wyckoffs on Thursday, so you won't want to miss that. That should be a great one as well. And as far as today's agenda, we have our February seasonality report, Tom. You're going to be doing a great job of that, I am sure. And Grubhub is going to be our first 10 and 10 symbol. And finally, we'll finish up. I'll do a little bit of a sector rotation study for you. So let's go ahead and get started with those technical news and headlines. I know there were a lot of earnings.
Yep, a lot of earnings. We'll get into the economic reports here first. We got initial jobless claims. This was a shocker this morning, and initially the response was pretty bearish. We saw futures take a pretty good hit when the initial jobless claims came out. 253,000 versus 220,000, much higher than expected in just 1 week after we had that 199,000, which was the first reading below 200,000 in a long time. So again, we got a lot of flip-flopping going on in the market, but so far the market shrugging it off, and that's what typically happens in bull markets. So we'll have to keep an eye on that. December personal income and personal spending. You see the estimates there on the screen. Both of these reports were delayed based on the government shutdown. Not sure when they're scheduled to be updated, but thought we'd still pass along the estimates. January Chicago PMI came out at 9:45 Eastern, way below expectations, 56.7 versus 62.5. And adding fuel to the fire, December Chicago PMI was revised lower, 63.8 versus 65.4. And then finally at 10 a.m., a big boost for the market. November new home sales. Yesterday, pending sales came out way below expectations. This was a real strong number. November new home sales, 657,000 versus 560,000. The only caution here is we are talking about November, so we're looking back a couple of months. Market's already priced a lot of this in as we've seen the home construction performing really well, but that group is trying to break out today. All right, let's take a look at the 10-year Treasury yield, and this is the problem. This is the one big problem I have with the market right now. Otherwise, I could probably get behind a lot of what's going on. But the 10-year Treasury yield, which led the market to the downside. Remember, 10-year Treasury yield put in this double top at the beginning of November, and we saw this huge decline, which normally foreshadows a weakening economy, or at least one that's not as strong as we had it previously expected. And I think a lot of the earnings reports that are coming out are confirming that thought process. But on the rebound, this rebound was much more shallow in the 10-year Treasury yield than what we've seen in the S&P 500. And now, over the course of the last week and a half to 2 weeks, you can see we have really rolled back over, dropping from 2.80% on the 10-year Treasury yield down to 2.63, almost 2.64% currently. And that means money's rotating into treasuries. It's kind of unusual that you're going to see money rotating in so heavily into treasuries and equities at the same time. Really about the only time I recall seeing this was when we had, the Fed supporting the market. The QE, all the QE that was out there, the Fed was actually buying these treasuries and so forth, trying to keep interest rates artificially low. And everybody else was piling on in the treasury space because they knew the Fed had their back. Everybody was buying treasuries. The rates were going down. The result of that was keeping rates artificially low, which helped spur economic activity. So we saw the yield dropping while the S&P 500 was going higher. But this is a different time period, a different situation. And yes, the Fed is starting to talk a little bit more dovishly, but at the same time, I don't know that I would be expecting the yield to be dropping like this. So the bond market, to me, is suggesting economic weakness ahead, or at least not the strength that maybe what the stock market is showing us right now. And I tend to pay more attention to what's going on in the bond market than what's going on in the stock market. So this would be the one question mark, big question mark I have about this current rally in the market. Anyhow, let's get into earnings because there were a ton of those. I'll just bring those up on the screen here for you quickly. The only two disappointments among these large companies in terms of last quarter's earnings per share were the bottom two down there, Dow, DuPont, and GE. But GE came out with other bullish comments and the market responding favorably there. Dow, DuPont, though, as I showed, was a laggard, and it is by far the worst performer in the Dow today. But let's take a look at some of these charts. Before I get into individual stocks, I thought I'd start with the XLC, which is the communication services ETF. Here on this chart, this is a big breakout here today. Not only is it breaking out above the earlier high in January, but right now we're taking out that early December high on the XLC. Now, if we fail, leave a tail up above, reverse back down, close near the low today. Who knows with Amazon coming out and then the jobs report tomorrow? At least beware of the possibility of a reversal. That's what I've been looking for throughout the past 2 to 3 weeks, I would say, is looking for key reversals at major resistance levels. And to be honest, we really just haven't seen that. The bulls have been very impressive in taking prices higher. Even the XLC, which 2 days ago closed below the 20-day moving average, you can see that just barely. It did hold on to prior price support and has now moved back up and looks very strong. And we've been seeing this type of behavior in a lot of the areas of the market, not just the ETFs, but a lot of the industry groups, a lot of the major indices, the individual stocks. It's been pretty bullish. A lot of the reactions on the selling, we get a little bit of selling, hit a major support level, and then we take off, similar to what we're seeing here on the XLC. All right, let's pull up the industry group that's leading the charge here, and that is the internet space. Internet's really languishing for quite some time, but looking a little bit like a bottoming head and shoulder pattern where you come down, put in the neckline, left shoulder, come back up, set that neckline back down to a lower low that establishes the head, move back up, slightly upsloping neckline, which I like to see, pull back, hit the right putting in the right shoulder on the 20-day moving average and a breakout, and this is going to be with good volume. So this pattern certainly looks bullish to me. Now let's take a look at Facebook. Facebook was the reason for it. Facebook did come out with their earnings. They beat on their top line, $16.91 billion versus $16.4 billion. They beat bottom line, $238 versus $217. Look at the reaction here. The stock up almost 12.5%. 50 million shares already have traded. And if we scroll back a little bit, let's go back a year so that we can take a look at the volume on that selling. Remember the big day that we had all that selling? That was 175 million shares with its July earnings. Today, it's already at 50 million. It looks like it's probably going to go over 100 million, which won't be as much as we saw on the sell side, but that is still a lot of volume confirming a breakout of a downtrend. So I haven't been a big fan of Facebook, but with this earnings report, kind of hard to argue. They did raise guidance going forward as well. Let's take a look at, let's see, what else? Let's take a look at the XLB. This is the group that's getting hit today. And I mentioned the 20-day moving average. When we pull back, we've got strong PPOs across many areas of the market. We pull back, hit that 20-day, we're holding and bouncing off of it. That, to me, is a bullish signal. Now, within this space, Dow DuPont belongs to the commodity chemicals group. And so far, even though we were very weak, look at the PPO positive. Everything looked like it was falling apart earlier, but we have climbed back above that 20-day moving average on the commodity chemicals index. DWDP, looking at that stock individually, we have not seen that recovery back up above the 20. So this one I would be a little bit more cautious. Quad, maybe a quintuple top up here at about $60. So far failing. Until Dow DuPont can clears that $60 level or at least get back up above its 20-day moving average, I'd be a little bit cautious here. In earnings, let's go through some of these. Microsoft or Mr. Softy did miss on the revenue side. Top line fell a little short, $32.47 billion versus $32.53 billion. Beat on the bottom line by a penny. I need to see the breakout here, but still, given the fact that they came up short on revenues, I think stock's holding up pretty well. Let's take a look at Visa, maybe just one or two, and then we'll get into upgrades and downgrades. Visa, you can see this was a company that did beat top line, beat bottom line, but actually traded at about a 3-week low after the report, trying to rebound like so many others, though. Nice hollow candle. And then the last one I want to pull up was PayPal. PayPal missed they matched top line estimates, beat on the bottom line, but they guided their Q1 revenues lower. Nice breakout prior to this report. I would have expected maybe a little bit better news than guiding Q1 revenues lower, but the stock has rebounded off of its earlier lows, trying to get back up close to its open. All right, Erin, upgrades, downgrades, what you got for today?
All righty, let's take a peek. I'm going to start off with our upgrades. First one, it's in the utilities sector, Alliant Energy Corp. And today it was upgraded by B of A Merrill from an underperform to a neutral. I was looking at this. I do have the PMO buy signal in oversold territory. The PMO is just about ready to be positive, so I like that. You can see actually over here that we got a little warning about this rally because we had the rising bottoms here on the OBV, and the bottoms here were almost even. So that was telling us that there was some volume behind this, the consolidation, and it was going to lead to possibly a rally. And sure enough, right now, this is the area of overhead resistance I'd be watching. And you can see it's right now just up against that $44 level. In fact, the last, what we got last was $44 exactly, up over 1.5%. I'd like to see it get above that. You can see the 20 getting ready to cross above the 50, and that would give me an intermediate term trend model buy signal. So I think Alliant looks pretty good on this upgrade. Pfizer was actually upgraded by 2 agencies today, Credit Suisse and Argus, from neutral to an outperform. This one I thought looked very interesting. I've got the PMO. It's now managed to get itself turning the right direction. We don't have the buy signal just yet. You can see improvement in the scooter. We got the breakout, above this area of resistance. We had gone down below the 200, so it was good to see it manage to get itself back up above that. And now it's butting up against this declining tops trend line. I suspect it will be okay. We had some great volume coming in over the past few days. So I would be looking for that breakout and a move up to $45. At this point, that's what I like on that one. For Pfizer, Ralph Lauren was upgraded today from a market perform to an outperform. Doesn't seem that investors are all that impressed with this particular upgrade. But I have to say, I think this looks pretty good because we did get a move. Yesterday, we closed above this area of resistance. And you can see that matches up with that October low and the bottom of that gap that we had earlier in May. So I think just getting it back above that, you can see the 20 is getting ready to cross above the 50. And again, that would be an intermediate term trend model buy signal. I think this one looks pretty good. The next area of overhead resistance, I mean, if you want to look at this low back here from June, that puts us near that 125 level. But really, I think that the area of resistance that I'd be looking at would be all the way up here, probably at 135, 140. So I think this one has some possibilities, although seeing it fall 1.25% on an upgrade is a little bit suspect. All right, some downgrades for you. JD.com, UBS upgraded it from a buy to a neutral. Got a nice little breakout today, and actually it closed above that area of overhead resistance that we were looking at. Look at the PMO here. Really nice rising, and actually you could even bring it all the way back here to this low. Rising bottoms on the PMO all of that time through October all the way into January. And now you can see we're getting the breakout. But look at price during this whole time. It was going down, then it was sideways. So, at this point, we're finally seeing that momentum that had been building. I suspect we're now, with this breakout, going to move all the way up to here, looking at $30 as a possibility. We did get the 20-50 day positive crossover, and so that is an intermediate term trend model buy signal. So we'll watch that one. I might add that to my watch list. All right, so while Ralph Lauren was upgraded, and Steve Madden was downgraded. I personally prefer the shoes, but everybody has their own thing. At this point, I'm looking at this reverse head and shoulders. It looks pretty textbook. I don't like that it came up before it started to come back down to form this reverse head and shoulders. But overall, it was in a downtrend, so I'm going to give it a little bit of a possibility here. But we need to watch this because you can see that this rising bottoms trend line on the from the head to the shoulder has now been, it broke down below that. And so I would watch that closely because usually with these patterns, if it breaks down below either the rising bottoms or if we're looking at a regular head and shoulders, classic one, then we look at that declining tops trend line. And so if I see a breakdown of that, I start to think the pattern is suspect or maybe is starting to fall apart. So I would watch this one closely, but if we were to get that breakout, if it can turn itself around here, the possibility, the upside measured move would be, let's see, 28 to 33. So that gives you a $5, add that to 33, 38, puts you really close to the overhead resistance all the way up here at those highs back in August and September. And finally, last one, Tension Holdings. This one I noticed was actually requested for 10 and 10, so cross that one off the list. I am looking at another reverse head and shoulders, and you can see I like this much better. It came down into it. I think it has a better possibility of following through. We got the breakout. You can see even if I had drawn that rising bottoms trend line, it never came close to touching that. The EMAs are really looking good. We don't have the 50 above the 200 yet, but really the 200-day EMA was also pretty strong resistance, made it through there. So with the measured move on this one, I would be looking for a move all the way up to $55. That is certainly possible. So I would watch very closely, though, that 50-day EMA. We do want it to get above the 200 and put this in an official bull market configuration. Those are all the upgrades and downgrades. A couple of the ones that we hadn't talked about here. Geron was upgraded, Eversource Energy, Helmerich Payne, Solar Edge, Tiffany's, Scott's Miracle-Gro. Those were all upgraded, and other downgrades. Allergan, General Dynamics, H&R Block, which is having a horrible day right now, Quest Diagnostics, and Silicon Laboratories all were downgraded today. All right, Tom, seasonality. Let's go ahead and get into that. I'm curious of what's looking good coming into February.
All right. Well, first, I'll just show you a chart of the S&P 500 while I talk about it for a second. As we look into seasonality, and this is just going back, for those of you not familiar with seasonality, strictly looking back at historical performance and trying to identify patterns based on seasonality. So today I'm going to talk about February, maybe talk a little bit about March and maybe even April that follows, just to give you an idea of what the market tends to do as we move into February. First, let's start with the S&P 500. Since 1950, February has produced annualized returns of 0.63%, which ranks 9th out of the 12 calendar months. However, I do want to show you that during the last decade, during the bull market, when you take a look at just the last 10 years, and here is, the slider, you can take a look at however many years you want to, but basically this is back since the beginning of 2009, which would encompass the last bull market. You can see actually that February is among leaders. February, July, and October have been the 3 best months on the S&P 500 over the last 10 years. So does that mean that the prior 50 or actually almost 70-year history is changing? I don't know. I doubt it, but just wanted to point it out. I mean, those who want to poke holes in seasonality, this would be one thing to do, because when, going into February of 2009, would have been talking about how weak February was, and yet the last decade, February's been strong. So I want to give both sides of the argument here. But it's still, a lot of times, I think as you look through some of the information I have for you, I think you'll see that some of it is pretty good information and can help, I think, in trading and investing. But taking a look at the S&P 500 again, February over the last 68 years, 69 years, this dates all the way back to 1950. February is 9th out of the the 12 calendar months. The NASDAQ, since 1971, has produced annualized returns in February of 7.81%, which ranks 7th out of the 12 calendar months for the NASDAQ. The Russell 2000 since 1987, and of course this is small cap stocks, they have risen 14.25% on average or annualized since 1987. So we're talking about a little over 3 decades. And that ranks February as the 6th best month for small caps out of the 12 calendar months. Notable periods during February. So I've gone back, and again, I've tracked how the S&P 500, the NASDAQ and Russell 2000 are almost identical. So I'm just going to focus on the S&P 500. But when we look at the S&P 500 performance within the calendar month of February, you need to know that right now we're in a bullish period. January 27th through February 3rd on the S&P 500 has produced annualized returns of 35.34%, dating back to 1950 over those 7 days. So we're about to wrap up a very bullish week historically. And you can see over the course of the last week, we've had a pretty nice rally. So that kind of coincides with what we typically see this time of the month. And by the way, for those of you who are not that familiar with seasonality, one of the most interesting facts for me when I went back and did this study is that from the 26th of one calendar month until the 6th of the next calendar month, so that's just a little bit more than 1/3 of the calendar month, that period of all calendar months has accounted for almost 100% of the gains in the S&P 500 since 1950. So the fact that the S&P 500 is in this bullish period at the end of January and as we begin February, that's typical of almost every calendar month. So, and the reason for it, in my opinion, is pretty simple. You have a lot of pension funds, 401ks. When I audited in public accounting, there were a number of companies that I audited that would have pay periods, say on the 15th or the 30th, 31st. And what they would do is they would accumulate their 401k withholdings, and once the pay period hit, they would send them in to the Fidelities or Vanguards of the world. And whatever the individual 401k participants wanted to be done with their money, Fidelity and Vanguard and any other company that is handling these funds would buy for those participants. They don't sit back and say, well, you know what, the market doesn't look very good technically, we're going to hold off a couple of days. They're required by law to do whatever the participants are asking them to do. So a lot of that money that goes into Fidelity, Vanguard, and Janus, and all these different mutual fund companies and so forth, this money gets invested. And so if you think about it, if there are a lot of companies, and I know from my experience as a CPA, many of the companies I audited had pay periods that coincided many times with middle of the month and end of the month. So you had money being sent early in the calendar month and then right after the 15th of the calendar month in many instances. And those periods tend to do very well. The 15th to the 18th is strong, and also the 1st to, like I said, 4th, 5th, 6th. That period tends to be very strong, and I think it is corroborated by the fact that money flows are coming in. So then you might think, well, why would the end of the month be strong if the money comes in to start the month? Well, you've got market makers, you've got portfolio managers, hedge fund managers. I'm not the only one that knows the money flows are coming in. They get it on board ahead of time. It's a legalized form of front running, in my opinion. They know the money's coming in, and they buy at the end of the month ahead of time. So I think that's why we see, or we have seen, the majority of the S&P 500 gains achieved or accumulated during that 10 to 12 day period, 26th of the month to the 6th of the month. So January 27th, February 3rd tends to be strong. February 4th to the 9th, negative 22.81% annualized return on the S&P since 1950. So once you get this period moving up, then you get some profit taking to kick in. Then we get into the period 10th to the 15th, up 24.35%, 16th to the 23rd, down 14.68%, and the 24th to the 28th, kind of unusual, 24th to the 28th only has an annualized return of 2.37%. So that just kind of gives you a little bit of a makeup of how February rolls. Bullish through the 3rd, tends to be a little bit more bearish from the 4th to the 9th. By the way, Monday is February 4th. So we're getting a lot of movement to the upside this week. Got to be careful maybe next week just because of profit taking. And that is a seasonal pattern, not just because we've gone up this week. Then the 10th to the 15th bullish, 16th to the 23rd bearish, 24th to the 28th more neutral, maybe slightly bullish. Okay, so that's the notable periods. Let's talk a little bit about sectors and which areas of the market tend to perform well in the month of February or as we enter February. XLE. So let me get into the seasonal chart, and I'm going to pull up the XLE. And we'll go back over the last 20 years. And you can see February, March, April. Look at this. February starts a pretty nice period for energy. This is the best time of the year for energy stocks. And energy trying to make a breakout. We can pull up that chart. That's the other thing. I always combine seasonality with the technicals. I don't just look at seasonality and say, oh, it's this is a great month for energy, I'm just going to buy. I like to look and see if I'm getting a breakout. Here, so far, we're getting a false breakout on the XLE, but we have been acting much more bullish, as you can see, holding on to the rising 20-day. So given the background that February, March, April tends to be very strong for energy, I think pullbacks to that 20-day moving average could be an opportunity for a low-risk entry into the XLE. If it fails to hold it, you just simply move to the sidelines. It also could provide some entries into stocks within energy. So you might want to take a look at some of the stocks that look good technically, pull up their seasonal charts, and see if those types of companies might make sense. So the XLE has been one of the best. Let's also take a look at the XLB. Now the XLB, if we go back and look over the last 20 years, look at February, March, and April, and look at the percentage chance that these months are going to go higher. February, March, April, just continually moving higher. Really strong time of the year coming up for material stocks. And another thing you can do here on the seasonality chart is compare the XLB to the S&P 500. So when I click go now, it's going to tell me how the XLB performs relative to the S&P 500. And notice February, the XLB averages outperforming the S&P 500 by 1.8% over the last 20 years. The only month better is November. So this tells me that this is the time of the year when the XLB tends to perform pretty well. All right, so let's take a look at the chart. Well, the XLB, you can see in January started to strengthen, is above the 20-day moving average. We tested that today. Looks pretty good as we head into February. Got a little overhead resistance we'll want to pay attention to, but it seems like we'll probably make a move up to test that area. All right, XLY. Talked a lot about consumer discretionary. It's one of my favorite areas of the market. It has continued to perform well relative to the S&P 500. And when you look back over the last 20 years, February, March, and April, this is relative to the S&P 500. Outperformance all three of those months by a pretty good margin, almost 1% in each of those 3 months. And when you look across the board at the rest of the year, only November really is as strong as these three. And look at February's outperformed the S&P roughly 3/4 of the last 20 years. March and April more like 2/3. So you've got a pretty strong seasonal pattern with the XLY. Retail loves February, March, and April. I'm going to talk about that in just a couple minutes. But first, let's take a look at some of the areas that lag the S&P 500 in February. Technology, you wouldn't know it from today. Technology leading the market. Of course, we're not into February yet. But February, you can see that there tends to be underperformance the next 3 months, the XLK versus the S&P. Not a whole lot, just a little bit. And if we get rid of the S&P and we get rid of that relative strength comparison and just look at the absolute performance, you'll see that the February performance is weak. March and April are not bad. It's just that it's a little less than what we see on the S&P 500. So on a relative basis, technology doesn't tend to lead February, March, and April. Also not performing great. I think this is more February than it is March and April, but financials. And so if we go back last 20 years, you can see that the financials have averaged losing 1.5% during the month of February. And I believe that makes it the weakest sector in the month of February relative to the S&P 500. All right, let's take a look. As far as industry groups go, I really just want to focus on retail because the retailers are so strong this time of the year. Let's pull up the XRT. The XRT, which is it's a highly diversified retail ETF. So the last time I looked, I think the highest percentage of any stock within this basket of stocks in the XRT was like 1.35%, something like that. So it is widely diversified. There's no individual stock that really has a major impact on the XRT. Take a look at February, March, and April and how the XRT has performed. And then let's compare it to the benchmark S&P 500. Now you can see that in February and March, the XRT has outperformed the S&P 500 67% of the time in February, 83% of the time in March. And look at the outperformance, almost a total of 4% between the 2 months. So if you're looking for a seasonal sweet spot as we head into February, retail is an area I think it would behoove us to take a look at. So what I'm going to do is I'm going to take a look at individual stocks, and I can show you quickly. Let's go back over here. Go back to the dashboard under Member Tools. And what I did is I went into the scooter reports. So here is a way to combine technicals with seasonality. So here are all the stocks, all the large cap stocks, scooter ranked from highest to lowest. All right. Now, we just want to look at retail. So one of the things I can do is go in here, type retail. Now, if you notice, there'll also be REITs in here. I'm not really interested in REITs. So I just type in retailers. And now I'm getting all of the large cap stocks with the best scooter ranks. And I can now take a look to see how these stocks perform seasonally. You've got a little icon there. All you got to do is just click on it. So Alta, which has the highest scooter score, doesn't do so well in February, but look at what goes on in March and April. So this is one I want to be aware of as we get in. And technically, if it looks good in February, I would still buy it, knowing that you've got great seasonal pattern coming up over the next 4 months, but especially March and April. So then the question is, okay, what's the chart look like on Alta? I know the scooter's high. Well, it's broken back up above the 20-day moving average. Seems to be trading pretty strong. I think as long as we continue to trend higher, this is a stock to consider, especially based on the high scooter rank and the upcoming strength in seasonality. All right, let's go back and take a look at those retailers again. The next one, I made a list of some to take a look at. All right, we'll take a look at Dollar General. And by the way, I do have a poll running if you haven't checked it. There are, I think, 5 stocks on there, indicating 5 stocks that have really strong tend to have strong seasonal performance, February, maybe even March, April. And so based on the current technical picture, just wondering which of these strong seasonal charts you might be most interested in. So take a look at that poll, and I'll go over that in just probably about 10, 15 minutes. All right, Dollar General here is, now this only goes back 11 years. So, it's like any sample. The larger the sample size, the more representative it is, and the better, I think, more reliable it is. So Dollar General only has 11 years. So that makes me a little leery, but you can see February's okay. March, April, very strong. And you can see the percentage chance rising as we head into March and April as well. So February, okay. March, April really starts to pick up. So Dollar General is one maybe to keep an eye on. Foot Locker. And this also comes off of that large cap scooter, high scooter report. Now, when I look at Foot Locker, February 2.5%, that's pretty good. March 8.8%, and you can see more than 2/3 of the time February and March move higher. So let's take a look at the Foot Locker chart, see what's going on. Again, we got a high ranked scooter. Just recently broke out, by the way, above the highs in December. So I think you got a nice relative performer, and the stock's pulled back right near the 20-day moving average. I think Foot Locker looks pretty good here. All right, how about O'Reilly? This is another one of the large cap seasonal stocks. to at least consider. Going back 20 years, look at the little stair step here, February, March, April. Look at these average returns on O'Reilly. 3% average February return, 2.4 March, 4.6 April. Add them across right there, and you've got 10%. Got a stock that averages going up 10% February through April over the last 20 years. 10% is a good return for the year. This company has averaged it over the February through April period over the last 20 years. All right, let's move on to the mid caps, because this one kind of floored me when I saw Burlington. Now, this one doesn't have a long track record, only 7 years, I believe. Yep, 7 years. But look at February and March, every year up. Look at these average returns, 5.9, 6.7. So over the last 7 years, it's averaged going up 12.6% just in the months of February and March, and it hasn't had a down month in those 2 months. So what does Burlington look like? Well, just trying to break out. Look at all these successful tests of the rising 20-day. So as we head into one of the best seasonal period for Burlington and for retail stocks in general, I think the chart's looking pretty good. Again, this is one of the reasons why I'm still pretty bullish on the consumer discretionary stocks. This is an area of the market that has continued to hold up well. All right, let's go to the small caps. Flowers, 1-800-Flowers, FLWS. Pretty interesting chart here. Seasonal and technical. All right, February, 1.5%, not bad, 50-50. March, 90% over the last 20 years, 90% of the time it's gone up, and it's averaged going up 9.6% just in the month of March. April, 3.8%. Now, usually the market looks ahead. I mean, one thing I was thinking, well, February is Valentine's Day. Usually the market doesn't react to what happened last month. Normally the market anticipates what's going to happen. So I'm not quite sure why the March outperformance, other than the fact just that retailers in general are strong. But FLWS, let's take a look at the chart here. They reported earnings, by the way, today. And I'm going to see if I may have jotted down their earnings. No, I didn't. I did say that they reported stronger outlook, though. I know that they raised their guidance. So not only did they beat top and bottom lines, but they also raised guidance. And you can see on the chart making a pretty good breakout. If I go to a weekly chart, we are trying to make a breakout on a weekly chart here. This goes back the last 3 years. And you've got a stock that performs well, very well, March and April. So I think Flowers, 1-800-Flowers is one I'd keep an eye on. Pullbacks, I mean, these are the types of stocks I don't like to chase. So these are the kinds of stocks, knowing that the technicals are strong, knowing that upcoming seasonality is strong, it wouldn't be a bad idea to keep a chart list. And you can do that so easily here at Stock Charts if you're a member. Just type in your symbol. I mean, literally, I could go in here and just say save as. Here's my chart. I could click save as, put it in whatever chart list I want, add, and it's there. And so I could have a chart list that's called seasonality or strong seasonal performers. And every couple of months, I could just weed them out, go to the next set, but just constantly have stocks so that you could flip through and find stocks that have seasonal strength. And then when you find a stock that's also making a technical move, those would be stocks that I would give tremendous weight and consideration to. All right, let's take a look at another one here. These are all small cap again, remember, so they're going to carry a little bit more volatility. Need to be aware of that. But let's take a look at LQDT. Liquidity Services. This one is kind of strange in that it just has 4 really good months, and then the rest of the year is not so great. Kind of reminds me a little bit of Booking Holdings, formerly Priceline. We'll talk about that one in just a couple minutes. But here, LQDT, look at February, March, April, May. Add that across, 6.2, 9.7, 21.4% over the last 14 years. This company has averaged going up 21% February through May. Look at the rest of the year. Minus, minus, minus. There's one good month. Minus, minus, minus. For whatever reason, the stock loves the first half of the year through May. And after that, you don't want any part of it. Look at the percentages. So not only is there a much better chance that you're going to be higher, but you can see the returns are significantly higher. All right, let's take a look at TITN. Oh, and by the way, let's take a look at LQDT on the chart. Well, we already had the breakout. Now, this one, volume can be a little lighter, so maybe it's not for everybody. Huge move, though, in January to take out the prior low. As you get back down and have a 20-day test, knowing what we know about this company going forward, you got to decide if it's for you because, again, it's small cap, going to carry a little bit more risk, not as much volume, so illiquidity can present a little bit more risk as well. But hopefully you're kind of getting the point. Combining these two can be powerful. TITN is one. I'm going to go ahead and skip it on here, but you can always take a look at it. I'm going to go to ZUMZ. Zoomies. This is one on the poll. So let's take a look at Zoomies. Look at this. Over the last 15 years, look at February, March, and April and the returns. 6.4, 9.0, 3.6. Add those across, 19%. Average return February, March, and April. So we know retailers are strong these next 3 months. Here's one of the better performers seasonally, ZUMZ. What does this chart look like technically? Looks pretty darn good to me. Nice volume off the bottom, trading above the 20-day. We keep just trending higher, and we know we got the best 3 months to go coming up. 20-day test, I wouldn't be chasing it. But this is one, again, put in a chart list. You see a 20-day test, might be a great time for entry. All right, as far as the S&P 500 goes, now I've really just focused on retail stocks there because retail tends to do so well over these next few months. But I also went through and looked at the best performing stocks in the S&P 500. So this doesn't just include retail. It includes all areas of the market. And I mentioned Booking Holdings. I talk about this one all the time. It's one of the more amazing seasonality charts out there. Take a look at the first 4 or 5 months of the year. January, February, March, April, 5.7, 8.6, 8.0, 8.4, 3.1. That's average monthly returns over 20 years. Look in the second half of the year. September minus 7.8%, December minus 1.8. If you add up the first 6 months and then add up the second 6 months, this isn't even close. I mean, if it was a football game, it'd be 70-0. Booking loves the first half of the year, can't stand the second half of the year. So what does Booking look like as we are, moving into February? Well, just recently broke up above the 20-day moving average, some good volume coming in. Another one, I think, PPOs turned positive. This is the seasonal time of the year. And by the way, look what it was doing in the second half of the year, just drifting lower. And if you go back and look at a long-term chart, it's pretty amazing to look at Booking and what that stock has done. All right, a couple others. Let's take a look at Adobe. All right, Adobe going back the last 20 years, February, March, April. What is that? 11, 12, 1, 16, 7. Averages going up 16.7% in the months of February through April. That's over the last 20 years. Look at the percentage chance. Look at these bars relative to the rest of the year. Adobe really likes February through April. What's the chart look like? Well, looks pretty good. Just hit the 20-day moving average. So coming off that 20-day test, it's been a really nice rally on Adobe. The stock's been up maybe $8 or $9 the last 2 days. I think it looks pretty good. Nice PPO. This is another one. If the market continues rolling, I think these are types of stocks that will likely outperform based on their technicals and their seasonal patterns. A few others, again, I'm not going to go over them. We're going to go ahead and bring the poll up here in just a second. But others that look good, Foot Locker, I mentioned that one already. CarMax, KMX, and NVIDIA. I will pull up NVIDIA's chart here and let you take a look at this because NVIDIA has been so weak. But NVIDIA really likes the next couple of months. So the fact that we are down near the recent lows and the overall market's been rallying, we didn't break down with the last warning. Maybe NVIDIA is ready to make another run here. Lagging, these are stocks that really struggle over the next month or two. F5 Networks, FFIV, EQIX, Illumina, ILMN. They just reported earnings. Pull that chart up here. You can see we did hold on to support, trying to bounce off of it, but stock doesn't look very good technically, other than the fact it's holding support. And just keep in mind, next couple months, not very good for the stock seasonally. Humana, HUM, and then McKesson. I believe McKesson reports after the bell today. And here is a look at McKesson. Stock trying to make a breakout, but it does report its earnings later today. If it warns, just keep in mind, February, March, not great time of the year for McKesson. All right, let's go ahead and pull up that poll. And I don't know if you had a chance to answer it. Or actually, before we get the poll, I'm sorry, let's take a look at the quick summary on the seasonality. Just a general summary. Some of the things I looked at, I always like to look at these. The index ranking, leading and lagging sectors, really in terms of industries, just focused on retail today. And then we went over a number of stocks that you can keep an eye on as we get into February and throughout the next 3 months, really. So, Erin, based on the poll, I don't know if you had a chance, but I put in there, I think, 5 stocks that I think I talked about all 5 of these, and we actually looked at all 5 of these charts as well. You have a favorite here?
I picked Zoomies. So I didn't cheat. I just went and looked. So that was my pick. And I couldn't tell you why. I just
did.
I didn't look at the chart yet, but I just looking at it, I was like, I don't see technology doing that well. I know we've talked a lot about retailers and seeing that lately, so that's why I picked that one.
Well, I can say that I normally would pick Booking Holdings, and I think Booking Holdings is looking pretty good. I would be fine with that one. But I'm going to go with Flowers, 1-800-Flowers, because of that breakout and raising guidance and heading in. I know February's not a bad month, 1.5% average return over the last 20 years. But March and April, more than 13% in those 2 months. And coming out and raising guidance, I'm going to go ahead and go with 1-800-Flowers here. So the overwhelming majority went with Adobe, and it might be because maybe it's one of the more recognizable names out there, and it is software, which has been strong. So
good, yeah, absolutely.
Yeah, but interesting poll. Thank you all for participating in that.
Indeed.
Yeah, and by the way, at the end of the show, I'd love to get a little bit of feedback. The survey, which is below your video player. At the end, make sure you check on that. Let me know what you think of seasonality and whether or not you think using seasonality with technicals can improve your results. I find it pretty fascinating. And I've talked about Booking Holdings, which was formerly Priceline, the last few years, and it has been holding true to form. We'll see whether or not it does in 2019, but I think the combination of the two, seasonality and technicals, can be really powerful.
Yes, absolutely. I know that, I don't use like one indicator. And I know you don't either. You have to get confirmations. The trick is not to have to go through too many confirmation processes. Yeah. That's when things get complicated. You have to pick those ones that work just for you. And I think seasonality is a real interesting one to take a look at, maybe to confirm what you're seeing on the chart,
Yep. And I'm always going to go with the technical. So I could see a great opportunity on the technicals, pull up seasonality and say, oh, this company doesn't do well, for the next 2 months. That is not going to change my mind, because if you look at this, it's not like the outperformance or the underperformance is 100% in every month or 0% every month. There are going to be, ebbs and flows back and forth. But it just makes me feel better if I'm getting a breakout. And I also know that the seasonal pattern lines up. I think that can really add something to your trading.
Absolutely. Well, we have a lot of requests to get to for the 10 and 10. I've been busily doing that. Here's the RRG. This is one of those times I'm pretty impressed with our audience. Notice all of these moving in that northeast direction that pretty much everybody requested. We have a few outliers here that we might get a chance to look at too, but I thought that was pretty interesting. And then as far as sectors go, here we go. consumer discretionary and technology, we're kind of back where we usually are as far as the requests go. So I thought that was kind of interesting as well. But our first symbol, of course, is Grubhub.
All right, this is a great one to show on my relative chart. Grubhub, part of the restaurant and bar group. Take a look, first of all, at the restaurant and bars. Since July, now, you wouldn't really notice that we're in a bear market if you look just at restaurants and bars. Yes, they had a rough December, but they've rallied right back up. They're not far from a breakout above the late November high. And so not only has the group been going up, but if you scroll away to the bottom, look at the group relative to the S&P 500. Restaurants and bars have been one of the best areas of the market. Unfortunately, Grubhub has been one of the worst performers within the restaurant space. So here you've got to move down. I think you've got a bear flag. Until we get a breakout above, say, $83 or $84, I would have no interest here. I always worry about a stock like this. It's in a great area of the market and is underperforming so badly. I mean, here's Grub relative to the restaurants and bars. It was sailing along back 4 months ago, and then all of a sudden just took this hit to the downside. I think the market is telling us something, has been telling us something. I'd be out of the stock, and I wouldn't be surprised if we see another warning based on the way the stock's been trading. So I'm not a fan. In order to get a little bit more comfortable with this stock, I'd need to see a breakout above, say, $84 and see some volume coming in with that move.
All right. The most popular in the chat room, and I know you talked about it earlier. I don't know if you've looked closely at the daily chart, but it is GE.
Yeah, GE, really nice move today. Very heavy volume, and we've talked about this. This company just outperforming, beginning to outperform, and showing a lot more bullishness on its chart. As far as annotating, when it broke out above $8, I was looking for a move to $9. And the reason, there was the tops at $8. Bottoming head and shoulder pattern, by the way. Left shoulder, neckline, head, neckline, right shoulder stayed above this head. And then we got the breakout, pretty good volume on that breakout. Here was the reaction high back here on the last breakdown. We went back up to 9. So when we got through 8, I thought if we could get through 8, we could see 9. We went a little bit through 9, but we were just kind of hovering here above the 20-day. And now we're getting another big move with heavy volume. I think GE really begun to improve its chart, especially on the daily chart. Weekly, it might still be a little ugly, but I think if it continues to hold key areas of support, I'd be okay with owning GE. If it goes back down and loses the 20-day moving average and gap support, I'd be out because of that long-term downtrend. But as long as it continues to hold there, I think GE goes higher. I think the next area is going to be up to maybe 11 and a quarter. We got up to 1077 earlier. 11 and a quarter, or maybe even on this gap down, you can see the reaction high went up to about 1140. I think 11 and a quarter to about 1140 is the next area I would look for maybe sellers to show up there.
All right. See the next one. I think you've heard of it. Amazon. You were talking about them reporting. I thought that'd be interesting to look at.
Yeah, I don't try to forecast necessarily whether they're going to beat or whether they're going to miss, but we are trying to get a breakout here on Amazon heading into earnings. Sometimes that can be a head fake. I don't think that is a reliable indicator that they're going to have a great report. I would instead maybe be looking at their relative strength versus their peers, versus the S&P, to see whether or not money has been flowing in. So first thing I notice here is that the broadline retailers, yes, it's been a nice rally, but we're still below that December low. When we look at on a relative basis, we are right at a key area of relative resistance. So I don't think we're getting any clues there. Amazon relative to the S&P, just kind of going along for the ride the past 3 months, which actually, considering how bad the market was, that maybe that's not a bad thing. And broadline retailers overall not quite regaining the luster they had on a relative basis when you look back to the first 8 months of the year. So I think there's some question marks here going into the Amazon report. But overhead resistance is really the key here. So if I was annotating, I think on this one, I would just look for that double top. And that's going to be the case on a lot of stocks, a lot of areas of the market. Can we take out that early December high? We're making a run for it. We'll see whether or not we can take it out. We'll probably know a lot more at about 4 or 4:30 this afternoon.
Okay. Let's see. Next up, Procter & Gamble, PG.
Yeah, PG and that more conservative or more defensive staples area. So let's pull the chart up, take a look here on a relative chart. Nice breakout or attempt at a breakout. I think what we have here is a nice little cup, handle back, and trying to make a breakout. Close over 96, I think, would be bullish, or right there. On a relative basis, you can see it is leading its peers. So you got nice performance there, nice breakout and relative strength versus the S&P. So I think this is a nice defensive play. So it's probably one that's not going to get hit as hard if the market pulls back. And it's one that should participate if the market keeps going higher. So this is a more conservative play and one that, to be honest, I kind of like Procter & Gamble here, especially if we get the breakout on today's close.
Okay. Let's see. Next one up, our only materials sector stock, Huntsman Corp, HUN.
All right, HUN. Well, we're starting to see some strength in the group, and we're starting to see, here's the group. This is in the same space, by the way, as Dow DuPont. So Dow DuPont weighing on the group here overall, which in turn is allowing the stock, Huntsman, to outperform the group because Dow DuPont is weighing on the group. Looking, though, across the board, I mean, I think you can kind of see on a relative basis, the group is not strong. On a relative basis, Huntsman's not been great versus the S&P. Got a little bit of an uptrend here of late. But overall, this, we want to see stocks and relative strength charts that are going up from left to right, going across here. And I think when we look at this, we're seeing mostly everything going down from left to right. So really the opposite of what we want to see. As far as the key levels on the chart, I think you got a breakdown right here at about 23.5, increasing volume. Big volume, we couldn't get through that 23.5 level. So I think the stock is squeezing. 20-day moving average providing great support to the downside, but quickly approaching 23.5 where we likely will run into some selling. So for me, it's probably more of an avoid at this point. I think there are other stocks that look better. But a move through 23.5 would start to make the stock look a little bit better in my view.
All right. Our only utility that was requested, American Electric Power, AEP.
Okay, pretty nice looking move here to the upside, holding on to the 20-day. I think that's conventional electricity. Nice move up in the group. The stock relative to its peers, very, very strong. And it's been holding its own versus the S&P. I think in a way, maybe this is a little bit more conservative, but in a way, this is similar to Procter & Gamble. I think it's a little bit more of a defensive play. So if you wanted to round out, I don't know what their dividend yield is. My guess is it's probably a decent one. But this is a company I think has got a chance to make a run back for that 80.5, 81 level to challenge the December high. Got a nice uptrend in play, I think maybe to the downside. Keep an eye on that rising 20-day moving average so far, holding nicely. But this is a more defensive way to play the market on the long side, I think.
All right. Let's see, next one in the restaurants and bars, Darden Restaurants, DRI.
All right, let's see how this one is performing relative to its peers. Not very good. I mean, I can kind of take a look. Here's the group that's been going higher. Here's Darden that's been going lower. And it looks like it is failing below its moving averages today. Look at the relative strength here over the last 3 or 4 months. Not good. This is not what I want to see. If I want to get strength, and restaurants and bars offers that as a group, I want to find stocks within that space that are strong. So Darden for me is not a play. I think as far as annotating this chart, the one thing that I really want to focus on right now in the short term is simply this breakdown right here below the moving averages. I mean, are we going to reverse off of that, or are we going to finish weak? The market's having a great day. The stock's down 1.5%, not performing well on a relative basis. It's one I would avoid.
All righty, let's see. How about the, GDX, the gold miners ETF? What are you thinking about that?
Yeah, I said a while back, I mean, I thought gold was looking a lot better. I thought that it was an okay trade. I'm a little surprised that gold is continuing to do well with the market doing well, but part of that's a function of the dollar that's been struggling. So GDX continues to trade well. I would stick with it. Don't need it on this relative chart. Let's pull it up on a different chart, a shorter term chart. I think a pullback to 2150 actually is buyable. A little overbought here. I wouldn't chase it. But when you get these pullbacks, you can see that that is the area we just broke out from. And then also pay attention to that rising 20-day moving average, which is just above 21. So I think it looks good. I think gold breaking out above 1,300 is very bullish. I wrote, I don't know, a couple days ago on my blog, I thought it had a shot maybe at 1370, 1380, whatever that high was on gold. And so I would expect the GDX to rise right along with it.
All right, let's see. Number 9, how about Alphabet? GOOGL.
Yeah, all the FANG stocks struggled 2 days ago, and I had pointed that out. That really led to some underperformance in the NASDAQ 100. But all of a sudden, the last 2 days, these stocks have woken up. And it's been, Facebook last night, Apple a couple of nights ago, maybe not the best report, but I guess maybe just laying some fears to the side on Apple, the fact that they didn't lower more than they did. Google's going to be reporting. Google's got a clear 1140. The good news is, and I don't have it on this chart because it doesn't go back far enough, 1,000, maybe down to that 980 area, very, very important support. And I would probably, connect this trend line here, which is close to the 20-day moving average. I think if Google were to go back down below 1,070, that would be problematic. Probably likely head back down to 1,000. But the flip side is a breakout above 1140 after it reports earnings would be very bullish. So Google, I think, is improving. This is one that I would be okay with if they come out with strong results. But again, I'm not going to hold, or I'm not going to take a chance into earnings.
Okay, let's see. The last one I'm going to give you is the high yield corporate bond ETF, HYG.
All right. Well, we are short term getting a nice move to the upside. And anytime you get these high yield corporate bonds moving higher, pretty good sign that folks are willing to take risks. So I think this is a sign that we're in a risk on. We got that risk on mentality, although you wouldn't know it by looking at the 10-year Treasury yield. So we do have a little bit of bifurcation there. I would just say on this one, we're hitting a clear area of overhead resistance. And if we fail with this move today above, I think short term, it's probably a sell. And then I would be looking maybe for a move back to test the rising 20-day and maybe even draw a line in here, these recent lows right in here just below 84. So I think short term, it might be a sell, pull back to 84, and then we'll see what happens from there.
Okay, and that does complete the 10 and 10. Here are the symbols that we did just go over. I will have those up in the Market Watchers Live chart list. Just go to the blogs tab, click on the Market Watchers Live blog, and the list link will be right there at the top for you. Okay, time for our final market update. Let's take a peek. All right. Well, as we can see, the markets are pulling back a little bit here. I mean, the NASDAQ still is looking pretty good, but we're getting a little bit of a pullback. There's that Dow that is still in negative territory. S&P 500 is still doing fairly well here. It's up almost 1% at 0.8%. NASDAQ, like I said, continuing to lead the market right now at 1.45% rise. And I don't have the NASDAQ 100 on here, but it is up 1 2/3% currently. Mid caps higher on the day. Russell 2000 looking pretty good, up a little over 0.5%. TSX also in positive territory for the Canadian markets, looking pretty good. Continuing that rising trend that had started yesterday. And we can see Treasury yields are lower at this moment, reading 2.64%. VIX is starting to rise slightly, but goodness, we got below 17 today. Currently, we're reading 17.17 on the VIX. UUP, the dollar is up. UUP is up 5 cents currently, and interestingly, gold is also up. GLD, as Tom mentioned, they usually do travel with a reverse correlation. This, to me, means that we have extra buyers of gold that are offsetting the rise in the dollar. So I think that's very interesting to see that on GLD. USO, we had a pretty good morning going, and now we have pulled back up only 3 cents right now. Looks like it might try to go negative, currently at $11.43. Still maintaining that rising trend, barely. TLT, big gap up and is still continuing higher. It is at 121.92. And that's all I have for my portion of the final market update. What do you got for us, Tom?
All right, just a couple things real quick. First, I've brought this chart up in the past, recently actually, the NASDAQ 100 versus the S&P 500. And you can see it's over the last 10 years done very well. And that's a good sign because the NASDAQ 100 is a little bit more aggressive. And that's what you want to see. I had mentioned, though, a couple of days ago that this was starting to turn back down on this weekly chart. Anyone that was here, it was probably back on Tuesday that I talked about this. But we were starting to roll over, and I was a little concerned. Well, you can see with the last 2 days, this weekly is now moving up. And that 2.56 level, the ratio, is back above that 20-week moving average at 2.55. And you can see if that stays, if we can continue to hold that, that's when the stock market tends to do its best. So this is an interesting development here in the short term. Whether or not it holds remains to be seen. Again, we got Amazon reporting after the bell. We got non-farm payrolls out tomorrow morning. Anything could happen, but this is at least a development worth watching.
All right, looks good. So I think it is time to move into sector rotation. And I did write an article on this on Tuesday. And since then, things are really are shaking up as far as the sector rotation goes. So I'm going to start with my diagram of sector rotation. And then I'm going to show you the sector scoreboard so we can see what's going on over here. So with this particular sector rotation model, what we look at is, trying to figure out where we are as far as the economy and what's going on in the market. And so when we start to see healthcare, staples, utilities leading, as well as real estate, which is part of financial services or was, that means we're in that early contraction period. And so what we want to start seeing is the financials doing better, and we want to see consumer cyclicals doing better, because that means, excuse me, we might be on the end of this contraction in the market. So those are the things I'd be looking at. Now, what I found interesting on the sector scoreboard, and I'm going to show this to you on the candle glance for sectors, but we just got a new signal in on materials. We will probably get a signal coming in today as far as the intermediate term trend model. We will probably get a buy signal on the industrial sector today. And it also appears that we're going to see the communications sector get a buy signal. So when I start seeing these flip to buy signals, that does give me pause. And I think at the end of the program, Tom and I will talk about it. Somebody had mentioned in the chat room, so is it time to call this off as far as the decline goes? These are some of the signs I like to see if we're going to come out of a decline, as well as seeing these sectors starting to improve. And we had just gotten the buy signal on XLY, and I just had gotten the buy signal on the financials. And so that's what I had written about on Tuesday for you. So once we start seeing the strength coming back in these two areas, and then we start seeing technology improving, that's really the direction we want to go. I found it interesting, though, that we did have industrials getting ready to have a buy signal as well. The interesting part, too, that I found when I was looking at this scoreboard is the fact that utilities still aren't on a buy signal, and that, as well as consumer staples. This has been the place where we've seen a lot of rallies and good action, and they're sitting on neutrals, and we haven't gotten those buy signals yet. However, the only long-term trend model buy signals we currently have are in healthcare, real estate, and utilities. Healthcare, real estate, and utilities. So in the longer term, we're still looking at, that contraction or just a little bit of concern still in the market, because usually when we do go into correction mode or in bear market mode, like I believe we are in, you're going to see these sectors doing better than their brethren. And so at this point, I do like seeing the financials starting to look good and consumer cyclicals starting to look good. But we're going to look at those charts in just a bit, because those are a bit different. All right. So here is the, let me make this bigger so everybody can see it better. There we go. So this is the candle glance of all of the sectors as well as the S&P 500. So what I did is I was looking at this just to see where our intermediate term trend model was set up, and that's the 20 and 50-day EMAs. And I noticed, I mean, I knew already we had gotten the buy signal in financials, and I did not realize that we were just getting ready to have one for, you can see the industrials. If things continue the way they are, which it should because it's well above the 50 and the 20, we should get that intermediate term trend model buy signal on industrials. And then materials, I found that was very interesting as well. I didn't know that that was shaping up to be a buy signal, but we should see that buy signal come in today. And then we have XLE not performing as well, staples, and there you go. That is a real surprise to me, like I said, to see that we still haven't gotten that buy signal. But you can see that we had that really deep pullback here, correction, and it's taken a while for it to come out of that. So we have been doing well in the staples area, but we just haven't done well enough to get price above that 50-day EMA, which would give us that buy signal that we're looking for. And over here, you can see healthcare. It's getting ready to have a buy signal as well for the intermediate term trend model. I'm going to just click on that real quick so you can see how close we are in the thumbnail, just a hair left to go. And again, as long as when you're looking at EMAs, as long as the price closes above the EMA, that EMA will start rising. So we should see this crossover come pretty quick as well. So I thought it was very interesting to see what was going on as far as my candle glance goes, because it has my PMO and the EMAs I use for the trend models. So, you know, all of these have really healthy PMOs pretty much. Utilities, one of the things I like about the utilities is that PMO buy signal is in oversold territory, and we're getting that move to the upside in the move to the upside for the utilities and price. So I liked that as well. And there you go on the financials. Let's look quickly though at the relative rotation graph. And there's a couple of ways you can do this. If you come to if you go to the sector summary, which I believe is right over here. And I wanted to look at this one too. So this is today, how everything is going along. And as you can see, staples and utilities are still right on up there, which is expected, like I said, when you're in a defensive mode. Although I have to say, seeing this rally coming, as we always talk about, on the back of you know, some of these defensive sectors, that could be a concern to think about. But let's see what's going on. You know, this is intraday. What happened in the last week? Where were we there? Real estate, industrials, and that's where we're starting to see that buy signal shaping up. So in the last week, we still are seeing, you know, the real estate sector and services is somewhat, I would say, well, no, I would say that's not going to be what I would be looking for. But real estate, and then you notice the utilities and healthcare and staples in the last week haven't been, you know, the highest performers. But being real estate sector, that is considered a defensive area. So seeing that one leading the way over the past week is interesting. Now over the past month, we've got all of these defensive sectors in the last month have not performed. They're still doing well. We see over a 2.5% move on utilities, which is the quote unquote laggard here, but we're still looking at some really great moves to the upside. I just thought it was interesting that these defensive sectors over the last month aren't the ones leading the charge in the rally and the bottoms that the bottom we've seen. And then when you look at the 3-month look as well, real estate's still up there. There's your healthcare, and there's staples are way down here. And over the last 3-month period, they have lost 2.5%. So real estate's still really the best performer here. I mean, over a 3-month period, we're looking at you know, over an 8% move. So still a very defensive area. I think it'll be interesting to see how it continues as we go forward. Okay, so I looked at the candle glance. haven't looked at the RRG. And this tells you which sectors are, moving out of leading and into weakening, which are, what are they? Healthcare, staples, utilities, and real estate. These are all the defensive sectors, and they're all starting to move southwest. They're all starting to weaken. But what's starting to rise? Communications. XLY is that consumer discretionary. There's energy, and there's industrials, which like I said, I'm starting to get, we're going to have a buy signal on soon. And then technology is starting to turn around. Financials aren't going the right direction. Don't like that. But we did get that buy signal. All right, so I want to take a look just quickly at those charts. Let's go back over here. We'll just go to the symbol. Let's start over here with XLF. And I'll just give you a quick review of these. So there's that new buy signal that came in. Here's one of the issues I have, though, right now. And I'm going to annotate this real quick, is the overhead resistance. Look at where we had all these bottoms back here in earlier in 2018. And we are right up against it, and we failed to get above it, despite this buy signal that we have coming in. The PMO is also starting to decelerate a little bit. So financials, I don't think, are completely healthy now, despite the fact we have that buy signal, just because we haven't gotten above that resistance level. That's what we really want to see, is financials breaking out there, and we're not seeing it, and the momentum is starting to shift lower here. So that worries me. And you can also see, as far as the scooter, XLF is not the best performer. All right, so let us go to the others that we want to look at. So we'll go to the industrials. And here we go. PMO buy signal. There's that intermediate term trend model buy signal that it was not official yesterday. This is the move today that gets the 20 over the 50, and we should get that intermediate term trend model buy signal. So again, at this point, we did get above that those bottoms we saw earlier in 2018. That was at about the $70 level. We've passed that, and now we've pushed above the 200-day EMA. So I would expect industrials to start performing better. All right, let's look at real estate, which has been the strong one. I'll just briefly give you a picture of that. We now have a nice breakout here on real estate. And if you look at the weekly chart, looks pretty good here too. Look at that breakout, really nice. PMO buy signal. The only concern I have really is the fact that these the PMO tops are declining while they're rising on price, and that could be a concern. I'd like to see the next PMO top get above the 2 level. And then I wanted to look at XLP and then a few others here. Let's go back to the daily chart. All right, look at the nice breakout here for staples. And let's go ahead. I'm going to show you the support resistance levels here. All right, so I'm looking at that short-term overhead resistance, and notice the 200-day and even the 50-day EMA were posing overhead resistance as of yesterday. Today we got a nice big breakout so far, and the next levels to look for, well, I think you could look at tops here at 54.50, but honestly, I would be looking toward the 56.50, and I still think that staples, they're starting to improve, and look at this nice rally. I would expect them to continue to do well. Okay, let's come back here, and I looked at staples. Let's look at technology, and then I'm going to wrap this up. All right, so when we look at the technology stocks, we are starting to see that improvement. The 20 is starting to reach there for the intermediate term trend model buy signal. So this is one of those sectors that is really what is good for bulls anyway, to see the improvement going on here. And I'm just to go back to what I was looking at on here. With intermediate term trend model buy signals starting to flip, it does give me pause. Tom, it gives me pause about what is going on as far as a bear market situation goes. And Typically, when I've watched, we've had this scoreboard. We had it in an Excel spreadsheet back when we would produce those reports. And I always noticed that you'd start seeing them flipping the wrong way when it was time for those corrections and the pullback. And then as soon as these started to flip to the buy side, you usually were in for a nice long rally. So I'm a little concerned about that, but at the same time, I still am feeling bearish overall. And that is really due to the fact that right here, my monthly chart, this is the one I keep pointing out to everybody. I still am seeing a decline in, we're getting a tiny bit of deceleration on this decline, but I want to see a bottom. And when I see the bottom, when we start seeing it turn up, excuse me, that's when I'll move out of bear market mode. I don't necessarily need to wait for the buy signal. If you look at a lot of these, as soon as we start seeing that turn on them, that's about the time you get the new rally. So that's what I'm waiting for at this point. And even off that big correction, same deal. So what do you think, Tom, about, that's the question that was in the room. It was the most popular one in the room.
Yeah. Why don't we first, I think you've got a summary slide just to kind of talk about some of the things that,
yes.
that you just went over.
Yep.
I've got a couple of charts that I'll kind of pull up quickly and go through those. Some of the things that still worries me about this move. I'm in the camp that believes we have a cyclical bear market and a secular bull. So I believe we're going to resolve to the upside. Have we already resolved to the upside? I'm not ready to buy into that just yet. I love what's going on. Seems like every time we get to a key resistance level, we take it out. I've had short positions on ETFs that I've been stopped out of on 3 different occasions now. I try each time we get to a key level. And what I'm waiting for now is simply to see if we get a reversal in the equity market. So this is what bothers me. The 10-year Treasury yield. If you notice the 10-year Treasury yield back in November as it kept moving lower, if you pull up the S&P 500 at the end of November, look what we were doing here. See how we had that divergence? The S&P was going up, but the yield was going down. It's like, okay, well, what's going on? This is why I pay much more attention to the bond market, because look what happened in December. All of a sudden, the S&P 500 said, whoa, we're going to go ahead and play catch up to what the bond market has already been telling us. Now look what's happening. We got the bond market again, the 10-year Treasury yield rolling over, and you go to the S&P, and the S&Ps act like nothing's going on. We're just going to keep moving up. So that's one problem I have with the market right now. Another problem, transports. If the market is really picking up, our economy is going to strengthen later this year, transport should break out. Weekly chart, we're up to the 20-week moving average. This is right where we had all of this congestion and support that we lost in December. Now we're testing it. I think that's a problem. Transports versus utilities. You were talking about sector rotation. I haven't seen enough yet on transports versus utilities. We still are in a lower low, lower high environment on this ratio. That bothers me. And then finally, it looks to me like the XLY, XLP, this would be the first weekly decline in this ratio since we hit the bottom and been rallying. That bothers me a little bit. You can see what happens when we start to roll over. So got some problems. We'll see whether or not, the market can withstand all of it.
Yep. It'll be very interesting to see that.
Yep. And of course, we got Amazon reporting after the bell today. So
yep. Our monthly charts go final today, too, for DP signals. So check those out.
Yep. Amazon, big report, and then non-farm payrolls in the morning. Anyway, thanks to everyone for being with us today. Please remember to complete that survey as you exit. Again, I'd love to hear from you on the seasonality. The survey is located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. See you back here tomorrow. Happy trading.
Is your portfolio positioned to profit from continued market volatility in 2019? Join over 100 investing and trading experts, including policy guru Steve Forbes, emerging markets icon Mark Mobius, America's best income investor Bruce Johnstone, elite energy analysis Stephen Shork, and trading visionary Tom Sosnoff at the Money Show Orlando to get the best ideas for protecting and growing your investment portfolio during 250 in-depth presentations. Claim your free pass now at orlandomoneyshow.com.